I'm joined by a great panel here. I'm Nick Elder with Ironton Capital. I oversee a lot of the capital raising and investor communication strategies with Ironton Capital. I've got Joe Massey here with now Synergy One Lending. I've got to get used to that. But how you doing, Joe?
Me too. I'm doing great, Nick. It's good to see you, and excited for everybody joining us today. For those of you that have not heard, I was with Castle & Cook Mortgage for 15 years and changed to Synergy One Lending just over 2 months ago. So I've been here since August 15th, and it's been a great transition. Really excited for a lot of the things that we're doing here, and I'm still doing loans all day, every day. So we're going to talk a lot about that, about how I can help you, and how our other guests can help you as well.
Awesome. Well, appreciate you being here as always. Always a wealth of knowledge and insight. I've also got Sean Ross with 1031X. How you doing, Sean?
It's been a good day so far, and I think we've got a good webinar here. This is my second time doing it with this crew. First time here with Stacy. I'm excited about that. I'm happy to be part of it.
Awesome. Thanks for being here. And then I've got Stacy Orrick here with Stacy. I'm totally blanking. Blue Federal Credit Union.
You got it. You got it. No, appreciate it. And I kind of am digging the fall weather. I think it's given people more time to think about their finances and all the different ways they want to kind of grow it to start spending in spring and future months to come.
Yeah, awesome. Well, really, really appreciate you being here. So before we jump into it, some of you that are on here, maybe most of you that are on here, you've probably owned real estate in Denver for a long time, and you've run into some of the, let's call it numbers challenges, as far as having very low leverage, enormous equity buildup over the last 10, 15, even 20 years investing in Denver. You're probably asking yourself, what do I do with all this debt equity? So we've got Joe here. Joe, again, being a mortgage broker with Synergy One Lending, he helps a lot of investors out with the cash out refinances that going down that path for those investors who want to do that. Sean deals a lot with 1031. So if you want to completely defer your taxes and your depreciation recapture and continue trading up into the next property, he's your go-to for that. If you don't want to do either of those two options, you don't want to do a cash out refi and get a new rate loan with a new 30-year AM, but maybe you want to tap into that equity via line of credit. That's exactly why Stacy's here. So we're going to go through a number of scenarios here, showing you what that analysis would look like. And then again, as you guys have any questions, please feel free to chime in here, and we'll address them as we go. So we have this at the beginning of every presentation. Ironton Capital, we're a private equity firm here based out of Colorado. We have a number of passive investments for investors that want to go away from the more active approach to the passive approach. We've got a number of real estate growth funds. We also have a private credit fund invested in medical receivables. So the reason I have this here is because you're going to see words such as project, estimate, aim, intend, expect, all the typical pro forma projection type buzzwords. Please understand, these are always forward-looking statements, always information that we have based on the most recent and best available information that we have with our operators and our sponsors that we work with in all of our funds. Nothing in here is really confidential. When it comes to looking at any of Ironton Capital's subscription documents, that's all confidential, but everything here, this is a purely educational webinar here. Of course, any investment just in general involves a certain degree of risk, whether that's a high degree or low degree of risk. A lot of what we do is to some degree high risk. You're making speculative bets in some capacity based off the projections that I highlighted in the beginning. And this is not an offering of investment opportunity. That is what the legal documents represent. Quick overview of the Ironton Capital team. Lon Welsh is our founder. Lon's got a really deep background, a couple of decades of experience in commercial and residential real estate, built one of the largest independent brokerage. Actually, I'm discrediting him. He built the largest independent brokerage in Colorado, spanning 750 agents, couple billion in sales, and he exited that to a private equity company in 2021, alongside the title company he sold to Compass. He's also got a lot of experience in strategy consulting with some of the big four accounting firms. Richard Landry, our chief investment officer, has a lot of experience in Goldman Sachs, working on Wall Street. Was a CIO at a $2 billion family office and a CFO at another private equity company similar to Ironton Capital before joining the team. And then Brent Geyer's our CEO. Again, a lot of experience spanning several decades in real estate acquisition and development. Obviously operating and managing his own portfolio, transacting on over $1 billion in total volume in that entire career of his so far. All right, I'm going to shut up. Joe, I'm going to turn it over to you now.
Nick, I was enjoying your part, man. I thought you were doing great. So before we dive in, I really want to ask all of our attendees, if you would put a comment in the chat box about what made you join tonight. Do you have a lot of equity? Are you thinking about repurposing equity? Do you join because you never miss an opportunity to hear myself and Nick and Sean and Stacy present? We love to know, why are you here? What do you really want to learn tonight? We've got some pre-scripted slides and some things that we're going to talk about, but would love to get your engagement. So if you would put a note in the chat, there's a chat box over to the right. Put a note in there of what do you specifically want to learn for your situation tonight. That's going to be really important because we've got a full hour blocked out for this, and we've got a lot of things that we're going to talk about, but we also really like to make it, customized to what do you folks want to learn. So our first slide here is we're diving in here. Average home prices. And you see there at the top, average home prices in Colorado have gone up 570% since 1991. Now that's obviously a long time. It's what, 34, 35 years ago. But if you bought a home for $125,000, which was the median home in 1991, it's now worth more than $700,000. And that 20% down payment is now worth more than $600,000 of home equity. Now, that is a huge amount of money that many, many people have seen and many, many people have had grow, whether you've owned homes for 20 years, 10 years, 30 years, whatever it might be, you likely have a lot of pent-up equity in your properties that you've owned. Now, maybe you're not from Colorado. You see our other highest states were Utah, Montana, California. Surprisingly enough, everybody always thinks of California as a real big boom state. It's actually only up 300%. So if you would have bought a home in California 30 years ago, you would have been better off buying and keeping that home in Colorado. So no matter where you're at, take a look at your state and see if this applies to you, that you have a lot of equity. Now, I'm guessing that you do have a lot of equity, and that's why you're here with us today. Now, we also did a comparison for the average home price growth compared to for Colorado, which is the blue line here. And I keep moving my mouse, but I keep forgetting you guys can't see it. And the orange line is the average growth of a home in the United States. So again, if you invested in Colorado in the last 5, 10, 20, 30 years, you've had an outsized return and likely have a ton of equity. And then over on the right-hand side, the green line, we compared to what would that 20% down payment have done had you put that money into the stock market. Now, I think we all agree the stock market is a great place to invest, but this proves that buying a home or residential real estate in Colorado can actually significantly outperform the stock market. Now, as Nick mentioned earlier, we're not here to try and sell you should buy homes, you should not invest in the stock market, anything like that. We just want you to see there's a lot of opportunity with owning real estate, which is probably why you're here. And maybe you want to continue to own real estate, but you want to find some things that can increase your returns if you have a lot of tied up equity. And looking at the comments on the right-hand side, that's exactly what I'm seeing. Folks have a lot of equity. Is it cost effective to get a refi or a line of credit? I have a lot of dead money in my rental homes in Missouri. Let's go back and look at Missouri real quick and see 263% return over the last 30 plus years. So if you've got a home in Missouri, you probably have a ton of equity in it. So let's talk about our first scenario here. And this is a spreadsheet that Nick and I put together as a partnership with Ironton Capital. And if you want to take a look at this, what you can do is reach out to Nick. And Nick, I'm sure you'll be able to put your contact information into the chat. And in about a 5, 10, 20-minute conversation, Nick is going to ask you some questions about your property. And then he's going to show you what would happen if you don't do anything, what would happen if you take cash out and refinance, what would happen if you sell that property, and what would happen if you were to do a home equity line of credit. So let's start here in the top left. And I understand this is a little smaller to read, but there's an icon with 2 arrows in the top right-hand corner where you can toggle the full screen view. So if you open that, it'll be a little bit easier for you to read. So over on the left-hand side, you're going to plug in, or Nick's going to plug in for you, your current property value. And let's just say this is a real example that we use, but let's say it was $475,000. Your annual appreciation, Nick, how much are properties appreciating right now in the metro area?
Whenever I run through this with investors, I usually say about, let's call it 2 to 4%, depending on where you're at. Historically, pre-COVID, the median appreciation was about 6% a year.
Yep.
If you have attended our real estate trends calls, which happen monthly, you've probably heard us say, we believe it's unlikely that we're going to be able to pace that or outpace that. I think it's unsustainable. So I usually try to estimate, let's call it and split it down the middle, about 3%. You put 5%. I also like being generous for the investor so they can see what it could look like on the more aggressive end. Then we can work down from there if we need to.
Yeah, you're exactly right. 5% is probably going to overstate the returns that you're going to get by holding that real estate in the coming 5 years. Maybe we're right, maybe we're wrong. I'm just like Nick. I like to actually understate it and put in 2 to 3%. But I think 5% is maybe a little bullish on real estate. But that's what we've put for this analysis. Next line is $225,000 current loan amount. In your monthly payment, $1,432. So this is a client that had very favorable financing, really low interest rate. Their net operating income is all of their income excluding the mortgage. So paying the rent, receiving the rent, paying property taxes, homeowners insurance, HOA dues, etc. What is the net operating income? And then after the mortgage, this property cash flows roughly $499. We'll call it $500 a month. Now, moving over to the right, what happens over the course of 5 years? Well, the value of that home is going to go up to approximately $606,000. That's assuming 5% annual appreciation. The loan balance is going to pay down. We all know how amortization works. You've got a $225,000 balance today. Over the coming 5 years, that's going to pay down to roughly $210,000. Your cash flow is this $29,000, almost $30,000 of cash flow, which makes sense. $500 a month times 60 months, roughly $30,000 in cash flow. Your net gain from appreciation, principal reduction, and taxable depreciation cash benefits is going to be $167,000. Over to the right, totaling up the cash flow and the net gain from other sources, this property is going to make you roughly $197,000 over the next 5 years. Now, your equity is in the top left where it says property information, $250,000. So that return on investment annually is 15.8%, and your after-tax projected return on investment in this property is roughly 10.7%. So Nick, let me pause there. Did I explain that well so far?
Yeah, definitely. And one thing I like that this spreadsheet does that a lot of other people don't factor in is what is that return factored in when you account for depreciation? That's a really key thing here. You were just comparing stock market, right? That's one thing you can't get in the stock market is the depreciation and the tax benefit. But everything was very clear there. So
thank you.
Pretty solid returns for in today's market, I'd consider that a very strong return, even on an after-tax standpoint. 10.7% is really good.
And I think that's the very first thing that I would remind everybody that commented on the right-hand side. I've got a lot of equity. I have debt equity. Even if you have a ton of debt equity and you're doing nothing with it, plug it into this spreadsheet. If you're still getting a 10% return and you don't do anything, I can't scoff at that, right? A 10% return, that's a great return year over year. There's a lot of folks in the world that would kill to get a 10% return. So if you don't do anything, you're still going to be in pretty good shape.
Mm-hmm.
Now, of course, this does factor in your marginal tax rate, which is how we determine that after-tax projected ROI. Now, let's go down to the second section here and talk about what if we were to take 75% out of this property. So meaning this property is worth $475,000. If we wanted to borrow 75% would be a new loan of $356,000. Now that's generally the maximum amount of cash that you can take out with a new refinance. Sometimes it's a little more, sometimes it's a little less, depending on credit, property type, etc. But generally, you can borrow 75%. You're going to have some closing costs, and an interest rate for an investment property loan as of today would be right at 6.75%. So your new principal and interest payment goes up. So now your payment goes up to roughly $1,839, and your cash flow goes down. We're borrowing money. We've got a higher payment. Cash flow goes down. Now, what do we get from this? We get, let's say, $50,000 that we wanted to invest into Ironton. So that is just a kind of an arbitrary number that I picked on this scenario. You could, again, go up to that full 75%. But in this case, let's just say we wanted to test out Nick and see if he's going to get us a good return. We don't want to put all of our eggs into one basket. We decide just to take out $50,000. Well, what happens over on the right-hand side? Our cash flow is less now, right? Previously, we were going to make about $30,000 in cash flow. Now we're going to make about $5,500 in cash flow. We're still going to get our appreciation, our depreciation, but we're going to get a little bit more principal reduction because we have a larger loan. Our projected return, if we were to put money into the medium-term fund, is roughly 16%. Into the long-term fund is roughly 19%. And we can go down a little bit further where you see net gain from Ironton, that $50,000 into the medium-term fund at 12% over 5 years is going to gain us $30,000. Or if we were to put that into the long-term fund, that averages 18%. That $50,000 investment is going to return us roughly $64,000. So further over to the right, the medium-term fund and long-term fund returns are respectively $206,000 and $240,000. So what you're seeing here, you're still getting the principal reduction, the depreciation, and the appreciation of this investment property, but you've taken $50,000 of that equity out, and now you're getting a return in the medium-term fund or in the long-term fund. So when you combine that after-tax projected return of the property of 10%, plus the medium-term return of 12% or the long-term fund return of 18%, over on the right-hand side, you're now getting an after-tax return of either 11% if you put those funds into the medium-term fund, or 15% if you invested into the long-term fund. So let me pause there. Nick, did I explain that section well?
Yeah, absolutely. And just to confirm, everything on the right-hand side, that is the blended return of keeping the property, doing the refi, and then deploying the $50,000 into one of those two fund options.
That's exactly right. And
Awesome.
so what you'll see in the graph on the bottom right in orange is what happens if you do nothing. You still get a 10.7% return. That's great. If you decide to do nothing, totally cool. The blue line is what happens if we were to refinance and take some cash out and put it into the medium-term fund. And the green line is what happens if we were to take some cash out and put it into the long-term fund. So again, this is not killing it. I think 15% is killing it actually, but the 10% is also killing it, right? So we're not telling you you're going to go from 10% to 30%, but if you have debt equity, this is one way that you could tap into some of that equity and start getting an outsized return, because right now that equity is only earning you 10%.
Mm-hmm.
So let me pause there. Any questions?
It'd be an interesting experiment here. I want to point something out here too, Joe. Let's change
Please.
how much you want to invest in Ironton. Let's change that to the max available to withdraw on the cash out scenario.
Yeah. So that's over here. Again, I'm pointing with my mouse, but you guys can't see it.
Yep.
This will be great on the recording. You can take out up to $120,000. And if you were to take all of that money out, you would see the net gain, if you put that into the long-term fund, would now be getting you even more of a return, because you're going to have more money at the 18%, right? So that blended rate would be higher. Now, the trade-off, though, is you may have negative cash flow. So if you were to decide to do that, you might think about putting a portion of it into the medium-term fund, which generates quarterly cash flow, and then putting another portion into the long-term fund that is going to generate you significant returns on a capital gains basis at some point in the future. So this is not, unfortunately, a live spreadsheet that I can change. Yeah. This is a PowerPoint. But again, for those of you listening, this is why you would want to reach out to Nick, because he'll walk you through this and show you exactly what this would look like for your individual scenario. Now,
I forgot
here's a
that
really common.
A 5 Excel spreadsheet. That's why when I asked you that question. So my apologies there.
You're good. But a real common question that, Nick, I'm sure you get is, okay, this makes sense, but Nick, I've got a 3% mortgage on my investment property. Why would I refinance to 6.75? Do you ever have someone say that to you, Nick?
Yeah, absolutely. Yep.
Every day, right?
Mhm.
Well, let's look at what if we wanted to keep that existing mortgage and we wanted to do a second mortgage. So the top section of this slide stays exactly the same. If we do nothing, we still get 10.7%. But down here at the bottom, what if we wanted to take out a line of credit for that $50,000? And this is where we're going to bring Stacy in. I would love for her to chat about this. What if we wanted to take out a line of credit for $50,000, include the closing costs into the loan? Now our cash flow is still going to be $170 a month, but we've got an additional $50,000 that we can invest into the medium-term fund or the long-term fund. So let me pause there. Stacy, if you would, tell us a little bit about your home equity lines of credit and how that works on an investment property.
Sounds good. And I think tonight we also have a Joe discount. I'm just looking at the new HELOC interest rate, but because Joe moved, we're going to move the rate. So, take 50 basis points off that. But home equities are a great product to pick and choose what you want to do with them. They give you fluidity to make decisions now or hold those off for later to make sure it's the right financial decision for your property. Couple of delineations, I would say. I think a lot of investors are more savvy with home equities. Most common HELOC you're going to deal with is going to require that the property be vested in your individual name. And they'll take a look at just kind of your basic income and output. At times they can kind of over stress test the cash flow that comes in on your rental properties. So that's the key thing to look at first is how is my property vested? And also who I go to, will they even do investment property HELOCs? And will they give me the amount or the limit that I really need for this too? A lot of lenders, if they do HELOCs on investment properties, they'll typically limit you to 100,000, 250,000, something along those lines. So first question is going to be, is it vested in my name individually or myself and another individual? If that's the case, a HELOC is probably going to be your most effective product just because the origination fees are going to be super low as long as the guidelines for it meet your needs. You're typically looking at 75% combined loan to value between your first mortgage and that HELOC. A lot of investors, though, when I see people saying I have a lot of equity, I just don't know how to tap into it. They already are vested in an LLC or some other type of entity, or perhaps they're invested in the home in the property with an additional partner, a non-spouse, a non-household partner that they need to be a little bit more strategic in how they borrow. Oftentimes people also have a pool of rental properties. I have 4, 5, 6 properties spread out, and how do I make it easy for myself rather than obtaining 5, 6 home equities? So if that is the case and that is the better fit for your world, potentially a business home equity would be the right fit in this case. You can be vested in your LLC name, multiple LLC names, S Corp, whatever that may be. The terms do tend to be a little bit shorter as far as just when they renew. It's not going to be your standard 20-year renewal on a HELOC, but it does allow you to cross-collateralize properties. So if you're sitting on 3, 4 properties, you want one line of credit you want to be able to advance on, you'll be able to tap into that and have just one loan, one payment, interest only for that period of time. So that is a convenience for the more seasoned investors, just because it's low hassle. It's not a nuisance. Some key things to pay attention to when we start to get into that space. $400,000 is kind of that magic number. If your loan size is going to be greater than $400,000, whether it's an individual property or a bulk group of properties, you're going to trigger appraisal requirements. So sometimes we'll have investors say, okay, I'm going to go ahead and lump these into 3 properties together for a loan amount of $390. I'm going to lump another 3 properties together for a loan amount of $375. So if you keep that kind of magic number, that sweet spot at 400 or less, as far as the equity that you're tapping into per loan, you'll save yourself a lot of time and hassle and money when it comes to appraisal values on these as well. Anything I might have missed, Joe, or anything we've reviewed prior that was interesting?
The question I've got, so again, I just made up these numbers putting this presentation together yesterday. So I assumed prime plus a half, so 7.75, but maybe it's better than that.
We're generous. Like I said, we get the Joe pricing because Joe lets us hop on here. So for us specifically, prime plus 0 is what your variable rate's going to be with an interest only payment. For those of you that like to have a little bit more of a comfort zone with fixed payments, you say rate environments going down, we do have fixed rate second lien products, 30-year amortization like a mortgage as well. So that's flexible. Key things on credit unions versus banks. Credit unions have no prepayment penalties, and then modifications too. So when you look at, is your financial picture going to be what it is now for the next 7-10 years? Wonderful. Is it going to change? Does it need a little bit of flexibility? Not having prepayment penalties can be a key piece, or being able to modify your loan structure, release collateral, swap collateral out and things like that. You do want to make sure you'd have that discussion with your lender first. But yeah, probably about prime plus 0 on the variable rate. If you're looking fixed rates, you're looking at roughly the lower 6s on a fixed rate term that resets every 5 years.
Okay. That's great to know. So for everybody that missed that, 7.75 is what I was estimating for a HELOC rate. As of today, 7.25. And there's a 96% chance that tomorrow that would be down to 7%. So for those of you that don't follow economic headlines, there's a big meeting of the Federal Reserve tomorrow, and there's a 96% chance that they're going to reduce the prime interest rate by another 0.25%, which would put Stacy's HELOC rate at 7%. Now, Nick, let me ask you, what's the amount that the medium-term fund pays right now? Is that between 11 and 12%? Is that right?
It's between 11 and 13%, depending on how much you have invested. So, yeah. So depending on how much you get as a loan on a HELOC and what your rate could be, there could be, you want to look at it from an after-tax standpoint, but there could be that arbitrage opportunity between investing in the MTI fund with a HELOC product. So there could be opportunity for that, depending on the rate that you can get. Now that arbitrage becomes a lot more attractive as the Fed continues to lower rates. That's been a lot harder in the last couple of years because HELOC rates have been north of 8%. Not that long ago, maybe 6 months ago, actually, maybe even like a month or two ago. So yeah, I think that's where you were getting at, Joe. Could be good arbitrage opportunity there. If you can make 12%, and your HELOC rate ends up being around 7%, your pre-tax difference there is about 5%. So,
yeah. And so you're leading the witness. That's exactly what I was going to ask. I'll share some of my personal information. I recently took a large amount off of my business line of credit. That is exactly like what Stacy's describing. It's secured across multiple properties. I took a large amount out of that I borrowed at 7.5%, placed it into the Ironton medium-term fund, and that pays me 12%. So 12 minus 7.5, I'm making 4.5% net on that. And what do? I take the funds that come in from the cash flow from the properties. That's what I use to pay the HELOC payment. And every quarter, I get a really large distribution from Ironton medium-term investments. And then what do? I use that to pay the HELOC down. So over the course of about 2 years, that business line of credit will get paid back down to a zero balance. And guess what? Now I've got a really large balance in the Ironton medium-term fund that continues to pay me ongoing indefinitely until that fund expires, which I think is a really long time down the road. And I'll cross that bridge when I need to. So Stacy, let me ask you this as a question. If I were to do a HELOC or a business line of credit across multiple properties, are there restrictions on how I could use those funds?
No restrictions. Advance it as you like. Use it as you like. I do think we partner well with your group as far as we add back the interest depreciation, all those type of things to maximize cash flow in that space. If it is across multiple entities, though, all I'd say is just be prepared to provide annual financials. Usually we do just keep a closer eye on making sure that the properties continue to perform as needed, but the flexibility is fantastic. If you do need to swap out a property, you sell a property, have a pay down, things like that, what you want is a lending partner who's willing to adjust the loan size and terms that would align with that as well.
Yeah. So I want to go back just a couple slides because there was something I saw that I really liked. Unlock your equity and put your equity to work for you like the banks do. All right. That's what I really like about this presentation is put your equity to work for you like the banks do. So one thing that all banks, including credit unions, they take money in on deposit and they pay a savings account rate of, let's say, 2% or 3% or 4%. And then they lend that money out to folks like us on this call at a rate of 7 or 7.25. And the bank makes money on that difference. They're getting the money from a depositor, they're lending it out. That interest spread, that is the bank's profit. And this is your opportunity that you can do the exact same thing. You could get a new home equity line of credit from Stacy at 7.25%, invest it with Nick in the medium-term fund or the long-term fund. That's now paying you 11, 12, maybe 13%. That difference in profit is how you get this blended higher return over here on the right-hand side of 11.3 or 15, depending on what you choose to invest into it. And a phrase that I learned not long ago is empires are built on a 3% spread. So we might be sitting here thinking, hey, a 4%, 4.5% spread, that's not really that much money. You know what? Wells Fargo, Blue Credit Union, Chase Bank, they have buildings and skyscrapers and stuff all over the place because they're making money on that 3% spread. And this is how you can do it exactly the same way. Would you say that's a fair analysis there, Nick?
Oh yeah, absolutely. Absolutely.
Just to add some color to that quickly, I before I did 1031 exchanges, in past life I was a financial advisor, and the gap between earning, say, 10% on an investment versus 15%, a 3, 4, 5% spread, there are really good advisors who scrape all around the country looking for opportunities to get an extra 2, 3, 4, 5% on their clients' portfolios. That's a really over the long term, you compound that, it's a really big difference.
Yeah.
Very
Absolutely.
Significant.
Stacey, so question for you. So in this spreadsheet, we're assuming a 70% max. Now we have people on this call, I'm sure, that they have completely free and clear properties. They own no debt. So they have more leverage that they can kind of toggle up or down, right? Or less leverage they can toggle up and down. If today's rates are paying around 7.25 on a 70% max loan to value on a HELOC, let's say somebody wanted to go down to like 50 or 40% leverage. Do they get a break on interest rate, or does that still remain the same at a prime plus half?
That's where I would encourage everybody, reach out to Joe first. I would say always start with the guy who has the lowest rates, right? And just make sure, does my property fit? Does my investment strategy fit in that space? He will be able to know and identify right away, cash out mortgage. If that's the space and the vesting is appropriate, yes, there's a lot of incentives when it comes to the rate side of it, when it comes to loan total leverage on the properties. As we get a little bit higher, that's where he and I work in tandem together to say, okay, what is that best fit? How can we maximize your yield by keeping your blended rate as low as possible in this space? On a HELOC or like on a business line of credit, there is no preferred price. A HELOC, yes, I will say so. Some lenders will say if you're under 70, you get a little bit better pricing, a little bit better margin above or below the prime rate. If it's a business home, if it's like a business line of credit secured by that, no, we don't differentiate. There is a little bit more forgiveness when it comes to loan to value. We can squeeze up to that 75, 80% in the right cases for the right borrowers. So if you are find yourself kind of stuck in that, I'm at 70, 75%, and I just need a little bit more. My next objective needs just a little bit more of equity out of the properties I do have. I'd say then let's look at the business line of credit after Joe can kind of assess it at first, see if squeezing it up a little bit higher makes sense. But there is no hit to the rate when it comes to stretching that loan to value in this space. But there are advantages if you do keep it lower on properties that are lowly or not leveraged at all.
Yeah, I love that. And Stacy and I, we work very closely together. So Stacy, if you don't forget, please put your contact information in the chat. If you call Stacy and she's like, you know what, you really need a first mortgage, she'll tell you to call me. If you call me and I say, you know what, you really need a second line of credit or business line of credit, I'm going to tell you to call Stacy. So please reach out to both of us. We definitely do a lot of transactions in tandem for a lot of the Ironton Capital clients. So now I want to talk about our star of the show, Mr. Sean Ross, has been patiently waiting to talk about 1031s. And so our next slide we've got here is what happens if you sell the property. So this is a common one that folks say, I have a lot of debt equity, but I just hate this property. It's haunted. Every time I put somebody in there, I get complaints from the neighbors. There's constantly a broken toilet. This thing is just a drag on my mental health. And you say, you know what? I want to sell it. I want to get rid of it. So we have a sheet here that, again, Nick can walk you through this for your individual scenario. But let's say you've got the exact same property here at the top left. If you keep it, you're going to get that 10% return. But what if you sell that property? Well, we're going to factor in what was your original purchase price? When did you buy it? How much depreciation have you used? And then when you sell it, of course, you're going to have to pay some commissions to a buyer's agent and a listing agent. You're going to have other fees, which is going to be title, the final water bill, the final HOA bill, whatever that might be. And then you're going to have to pay some capital gains. And this is a part that a lot of folks really get nervous about when selling property. And so in this example, you'd have about $25,000 of depreciation you've utilized, plus capital gains taxes of roughly $28,000. You'd still walk away with roughly $188,000. And then you could choose down at the bottom to invest that money into the medium-term fund, which would get you, again, that 12% return after tax, roughly 8%, or put it into the long-term fund, getting you roughly 14%. But I want to draw your attention to the bottom right-hand graph. The orange line is what happens if you do nothing. The green line is what happens if you sell the property and put it into the long-term fund. And the blue line is what happens if you sell the property and put it into the medium-term fund. Now, the reason the green and the blue lines start out lower, that is the capital gains tax that you would have to pay. So you might be sitting there thinking, I don't want to sell because it resets me and moves me back $25, $30, $40, maybe $100,000, $200,000, depending on how long you've owned the property. So Sean, tell us a little bit about a 1031 from a high level. How does it work? Why might we want to consider a 1031 instead of selling and reinvesting the proceeds somewhere else? Should we sell and reinvest into other real estate?
Sure. So for those of you who have been investors for a while, you've likely either done a 1031 yourself or have at least heard of it. But from a very basic standpoint, a 1031 exchange, it relates to a section in the IRS tax code that says you can sell an asset, and as long as you reinvest the equity from your sold property into other like-kind real estate, that means another piece of investment or business real estate, and you follow a litany of rules along the way, the IRS says, we're not going to recognize the proceeds that you got from sale as income. You're not going to have to declare them, pay taxes on them. You just get to take all of the equity from property A and put it into property B. Now, there's a lot of nuance between getting from property A to property B, but the punchline is if you want to take all of your money and not pay Uncle Sam along the way, this is the vehicle that allows you to do that. And Joe referenced earlier that investing in equities, and I'm a big equities investor myself, if you invest in stocks and bonds, there are certain tax breaks you don't get that you do get as a real estate investor. Depreciation is one of them. 1031 exchange as an option, as a tool in your tool belt, is another big one. It lets you skip over the capital gains tax. And for some people, if you own a property for a long time or a string of properties for a long time, the capital gains tax can be an enormous chunk of what you otherwise would walk away from closing with. Using a 1031 means that you get to continue the chain of investment and let your equity continue to grow uninterrupted. It's like a snowball rolling downhill faster than it otherwise would. I do want to point out that when you do a 1031 exchange, it doesn't prohibit you from then right after refinancing. So something you can do, something we say all the time, let's take a scenario. Let's imagine you're invested in Denver and you have been for a while, but you've noticed the appreciation slowing down. You've noticed maybe it's harder to be a landlord in Denver than it used to be. And maybe the neighborhood has changed and you're not getting the same quality of tenant as you used to. It's harder to kick them out if you have to. It's harder to make improvements. What do? Maybe you want to go to a market where it's more investor friendly. After you make a 1031 exchange from the Denver asset to some place where it's easier to be a landlord, or maybe there's some more upside on your appreciation, you can then, after the exchange is over, still do a refi and pull out some of the equity and put it to use through a fund like this. Nothing's stopping you from doing that. You don't want to refinance right before the exchange. You don't want to refi and then attempt a 1031. The IRS doesn't look kindly on that. But if you do it afterward, there's nothing stopping you. There's another intersection here that we should care about, which is what happens if you are curious about a 1031, you start the process, but then you don't find a property you want to reinvest into. One of the problems with a 1031 exchange is that you're limited in how long you have to look for new properties to reinvest into. There's a 45-day window from when you sell to when you have to identify what you're going to buy next. That 45 days goes by very quickly, especially if you're in a challenging market. So if you fail the 1031, you don't complete it, or you only complete part of it, you only reinvest some of the equity coming out of your sale. What are you going to do with the carcass that's left over? What are you going to do with the leftover proceeds? You're going to pay some tax on it, right? You could go into an opportunity zone, and that's a viable option for some people, probably beyond the scope of this webinar to go into in detail. You could pursue that, or you could take the after-tax proceeds that weren't invested through the 1031 and consider a fund like this, as Joe's been talking about. I can pause there and take questions from you guys if you want me to cover something more specific, but that's the general idea. How do you keep your equity working for you in a way that the IRS can't come in and take their share?
Let me ask you this. What if I bought a property? Let's go back to our slide we had in 1991 for $125,000. I've done a 1031 into a new property in 2000. I did another 1031 in 2010. I did another 1031 in 2020. Now I have a property that's worth $750,000. If I want to sell that, my capital gains goes all the way back to that original $125,000. So 750 minus 125, I've got what, $625,000 of capital gain at a 20% capital gains rate. That'd be what, $130,000 tax bill. Am I doing the math properly?
Yeah, well, in a loose way, yes. So the actual math to arrive there is actually very complicated, because every time you do an exchange, the adjusted basis carries into the new property, but sometimes you buy a more valuable property. So the increase in what you just bought, that's brand new basis added on top. But the whole time you're also depreciating, right? Or maybe you're making improvements. So there's lots of things that can affect what the actual final gap between basis and sale price is going to be. And that gap is what represents your capital gain. But on top of that capital gains tax and the depreciation recapture tax, you're also going to face the net investment income tax once you sell past a certain point. And there's going to be state taxes to consider as well. So yes, the chain of capital gain is going to go all the way back to the initial property that you first sold without a taxable sale. And for some people, that means that their 90% of their proceeds is going to represent potentially taxable income. It can be a really big bill.
Yeah, and I think that's the great point to understand about 1031s is it's a great way to defer your taxes. You can't avoid them unless you die, which I'm going to ask you about that in a moment. But it's a great way to just move the can down the road. I'm not going to have to pay those right now until I have this property that I just absolutely hate and can't stand it. And maybe now I got to pay the piper and I'm going to have a very big tax bill. But I'm sure you have other strategies to help us with that, such as a DST, Delaware Statutory Trust, things like that. Would that be true?
Yeah, that's right. And if somebody goes online and Googles 1031 exchange or 1031 exchange rules, one, don't just do that. Call somebody who actually has been through before, because you're going to find a lot of half-truths. One of the half-truths you're going to see is that you have to reinvest into what's called like-kind property. Like-kind is a very bad term. It sounds like it means if you sold residential, you should buy residential, or if you sold commercial, you should buy commercial. All it means is anything that qualifies as investment real estate can be exchanged for anything else that qualifies as investment real estate, which means the wealth of potential options is really quite huge. It includes everything from oil and gas and mineral rights to water rights to raw land. You could trade out of a piece of dirt and into the Empire State Building as long as the math worked out the right way. So there's a large number of different types of sectors and types of assets you could reinvest into. However, what matters more than that is, what are your long-term goals? What do you really want out of this? Are you going to continue to string together 1031 exchanges and do the exchange until you die strategy, which is a viable option? A lot of families build multi-generational wealth this way. Or is there going to be a point down the road when you're going to have to face the tax bill? And when you do, what's your strategy then? because you're just kicking the tax can down the road. This is not, unfortunately, a magic bullet that makes the IRS go away. It just tells them, hold on for a second, don't hit me yet.
Yeah. And there was a question here. If I were to sell a property and do a 1031 with Ironton, is there eventually a reckoning with the IRS in terms of capital gains tax? So Nick, let's shift that question over to you. Can we 1031 into the medium term or the long-term fund? You're on mute.
So you cannot do a 1031 into Ironton. Reason being, we're a fund of funds, so we're not directly managing the assets. We're finding the investments to deploy your capital into. So you're invested in a Ironton Capital LLC that does not necessarily hold direct ownership of the building. So that's the case for any fund that is set up like Ironton. So you can do a 1031, but an alternative strategy, if you want to pay the piper now, do you want to keep kicking the can down the road? And you know that in 15 years, you're going to be done with your 1031 exchanges, and you don't want to eventually face that reckoning day. One option, and we do this analysis if you have a property you're consider selling, but an option is to just sell it, hold yourself responsible for the capital gains and the depreciation recapture that you're inevitably going to be paying. And you can take some of that capital, once it's sold, money hits your bank account, you can invest in our National Diversified Fund into what we call our depreciation share class. And as long as it's a passive investment for you and you're not an active real estate professional, you can utilize the depreciation and passive loss pass-through that is generated from our fund to defer the capital gain that you ultimately have now incurred on your rental property. So as long as the depreciation and that sale matches in the same year, always discuss this with your CPA. I'm going off how a lot of our investors have approached this strategy. That is an option. So you've now paid your capital gains taxes. You've taken some of the depreciation to help offset or defer the capital gains taxes that you otherwise would have paid. And now your capital's at work, making 16 to 20% a year. Or you could put it into the income fund, reinvest the dividends at 12% a year, or take the dividends to replace the cash flow that you lost from the sale of your rental property. So we can run an analysis on this. We have one outside this spreadsheet as well. Happy to do so. Gary, if you want to reach out to me, I can send you the information that I would need to accomplish that analysis.
If you don't mind, Nick, I was just going to throw out there too, just because you mentioned chatting with your CPA on it. I would, and obviously we have former financial advisor here in this space, but I would also encourage you to look at an UPREIT, which is a way to slowly divest yourself in the 1031 space without having to recognize capital gains at that large degree. You start to receive different dividends and can slowly start to pull out gains over a period of time and still invest into Ironton. So you're actually capturing some performance there. So obviously I can't speak to it in detail, but something to think about as well is either between your CPA and your advisor that there are UPREIT options that can allow you usually a longer term plan to mitigate your tax burden too.
That's right. UPREITs are a really cool strategy, and especially a lot of institutions and wealthy investors use UPREITs as a way to transition out of actively managing their portfolio and a deferred strategy into something that's not going to kill them in any given year come tax time. There's other strategies similar to that called a deferred sales trust that you could attempt as well. That's a little bit more complicated, but it's the same idea, which is you're going to receive bits of income over time. You're going to recognize bits of tax over time that we're not getting walloped in 1 year. Mm-hmm. And Gary, just to drive this home, the reason that you can't 1031 into an Ironton fund is with any 1031 exchange, it only works if with the underlying thing that you're buying is real property. If you're buying limited partnership shares into a private equity investment, you're buying into the partnership. You're buying into the fund of funds. You're not buying the actual real estate. Yep. Some private equity funds are set up to accept 1031 capital. They're few and far between, and it changes the rules for the partners. So enter into those quite cautiously. It's not something that Ironton's doing that makes them uniquely, not 1031 eligible. This is very common for private equity investments.
Mm-hmm. Yeah. Something I would add, which I think would actually take all four of us on this call, is let's say you've got a property that you just hate, right? Tons of debt equity, just can't stand it. Toilets are breaking, tenants are difficult. I want rid of this. Call Sean. You could do a 1031 to sell that property, reinvest that money into the new property. Sean will help you with all the mechanics of that. I can help you with a new loan that you'll need because you've got to replace the debt on the property that you're selling. I'll help you with a new loan. Then, as Sean alluded to earlier, immediately following that closing, and Stacy, this is a question for you. How quickly after we buy a new property could we take out a new line of credit or home equity line of credit against that property? Do you have any seasoning requirements?
No seasoning requirements, at least in our world. Some lenders will. So obviously, Joe, great question to make sure you ask your lender about. No seasoning requirements for us too. And if some of these properties you're getting into 2, 3, 4 units and you see some opportunity to stabilize the property, right? We have a lot of mom and pop properties turning over right now to the more seasoned investors. But if you can raise the rents on those doors, we will look at that pro forma income as well in a short period of time. So potentially that stabilized value increases in a short order, and you can access more equity in the property then too.
That's a big deal. I did not know that. Very cool.
Yeah.
So immediately following that closing, you call Stacy, you take out $100,000, $200,000, $300,000 of your debt equity. Then you call Nick and say, Nick, I want to reinvest this money into the long-term fund or the medium-term fund or split it. That's a way that you can defer the taxes, get favorable financing terms, and reinvest it into something that hopefully is a better property, and reinvest that debt equity into Ironton, into one of their many vehicles to get you this higher blended return that you see over here in the bottom right-hand corner, and not have to pay, defer your taxes, not have to pay the taxes today. Sean was going to edit me in post-production later on that one. So I hope that makes sense. We're kind of getting close to the end of time here. Sean, can I ask you to put all of your contact information into the chat window if you would? And while we're wrapping up, if anybody has other questions, please go ahead and feel free to type those in. I'm going to put my information in here as well. And guys, what else? What other thoughts or questions did we not ask that we should make sure we share? All right. Well, Stacy, Sean, thank you both very much. And I believe, Sean, you've got a new book coming out soon, right?
Yeah, that's right. Lon and I have been spending most of the year writing a book together on private equity investments, 1031 exchanges, and DSTs. We just got through a final round of edits on our end before we go to another editor, and I'm quite proud of it. It's a good book.
Yeah, I was able to read one of the drafts, and I'm excited because I've got like a 1-paragraph blurb, I think on page 3, that says, I love these guys. They did a great job. I was one of the earlier draft readers, but really great information. You know, if this is something that resonates with you, I'd encourage you to get a copy of the book. It'll be on Amazon sometime within the next 60 to 90 days. And then we also have our Investor Success Summit. I'm going to put a link for this here right now. This is coming up on Saturday. So we've got about 150 different investors that'll be joining us. This is our annual trade show where we have presentations on fix and flip investing, buy and rent investing, how to pay off your mortgage in 10 years rather than 30 years, how to find foreclosures and pre-foreclosure properties, wholesaling, how to use hard money, and how to do passive investing. So if you're not busy this Saturday, November 1st, and you're here in the Denver area, would encourage you to join us for that. It's going to be at the PPA Event Center starting at 8:30 on Saturday, November 1st, going until 5 p.m. in the afternoon. So the link is there in the chat. Would love to have you guys join us for that. And with that, Sean, thank you so very much. You're always a wealth of knowledge. Really appreciate it. Stacy, this is, I don't know, 5th, 6th, 7th time that we've gotten to do one of these together. And I learned something, the UPREIT. I got to go Google that, even though Sean told me not to do that. I got to go learn about that. And just really appreciate having you as a business partner and a resource. And Nick, Ironton Capital, man, can't say enough positive things about you. Really appreciate you organizing this and getting the recording out to everybody afterwards.
Well, thank you to everybody for being here. And for those who attended, thank you also for taking the time out of your evening to be present with us tonight. Very grateful.